Is it possible that President Trump is intentionally crashing the stock market right now in order to get interest rates to go down? This is a theory that has taken the internet by storm recently. I'm gonna show you why, number one, it doesn't even make sense, and number two, what the current administration is actually trying to do. But first, we need a little bit of backstory. President Trump's goals have always been wealth driven. Before he was president, when he was a businessman and a real estate investor, obviously his only goals were wealth driven. Once he became president, even his administration and policy goals were always wealth driven. Better GDP numbers, better unemployment numbers, better stock market numbers. And it's very clear that the way he believes this happens is more spending in aggregate over the entire economy. Now, because of his personal history with real estate, it makes sense to him that business and spending is easier when interest rates go down. Also, because of his experience with real estate, he sees numbers go up when interest rates go down. And because his entire lens is wealth driven, it is reasonable for a person like that to assume if we can get interest rates to go down, all of the other economic numbers will respond by going up. This is a classic economic theory that if you get interest rates to go lower, that stimulates spending through borrowing, also stimulates investing and hiring, and the entire economy will boom as a result. Now, I need to be clear here. In this video, I am not making a defense of these arguments. I am not agreeing with them. I'm just trying to explain to you what it looks like the administration is trying to do in order to get our economy back on stable footing, regardless of how flawed or incorrect the reasoning may actually be. So if we look at President Trump's first term, it was very clear that he was targeting interest rates. He did it by targeting the Fed. This is because during Trump's first term, the Federal Reserve looked at that as an opportunity to unwind some of the damage that had been done from their response to the financial crisis. After the financial crisis, they had lowered rates to zero. They had blown up their balance sheet with QE. And when Trump got elected, he was able to get the Tax Cuts and Jobs Act pushed through, which meant the economy had extra wiggle room. There was more wealth left in the hands of the private sector. So the Fed looked at this as an opportunity to say, hey, we can tighten because there's room for us to tighten now. So they started raising interest rates, and they also started quantitative tightening and reducing the size of their balance sheet. Well, this didn't last long because President Trump wanted interest rates lower, not higher. He wanted more financial easing, not financial tightening. By the way, guys, I'm not sure if you know, but last year I launched a free newsletter. It is not just a regurgitation of my YouTube videos. They are deep dives on specific topics that I don't talk about anywhere else. Because of that, it's not like a daily or a weekly newsletter, but it is topical and it is time sensitive, which means when there's something going on, I'm going to do a deep dive on it and email you about it. So if that's something that you are interested in getting from me, go ahead and click on that link in the description below. And if you want a free gift for signing up for my newsletter, click the Century Portfolio link because you'll get my newsletter and you'll also get my free course and stock picks for my 11 100-year stocks. In 2018 especially, President Trump was doing everything that he could in order to get the Fed to lower rates again. With this tweet in December of 2018 where he said that it is incredible that the Fed is even considering another interest rate hike. Or this tweet saying the people at the Fed should read today's Wall Street Journal before they make another mistake. Now, because the lack of inflation at that time, the Federal Reserve did not have the justification to continue tightening, especially because the stock market also began to crash. And so President Trump got his way. Interest rates moved down, the Fed's balance sheet started moving back up, and the stock market had a massive boom that lasted until February of 2020. But financial conditions today are very different than they were back in 2018 and 2019. We had 4 years of trillions of dollars of government printing and borrowing and spending, jacking up the national debt to the point where the debt to GDP ratio is the same level it was at the end of World War II. It's currently at 120%, which many economists view as the point of no return unless things drastically change. And the most painful symptom of all that borrowing, printing, and spending was the inflation that it caused. The average American, your cost of living has gone up tremendously and much faster than it has at any point in the last 40 years. The Fed responded to this record-breaking inflation by raising interest rates to a point they haven't been in decades. But in September of 2024, they thought their job was done, and they began began to lower interest rates, thinking that they had won in the fight against inflation. But something strange happened. The moment the Federal Reserve began to lower their interest rates, the Fed funds rate, all other interest rates in the market started to head higher. Essentially, the market did not believe the Federal Reserve that they had won their fight against inflation. And by lowering the Fed funds rate, the market believed that the Fed was refueling the fire of inflation. In other words, by the federal funds rate going down, the market believed that that would make spending and borrowing easier, especially for the government, which would increase the money supply, driving prices up even further. And so long-term interest rates like the 10-year yield, mortgages, auto loans, and others started going up to compensate for this. As you can see here in an interview, Scott Bessent said the president wants lower rates. He and I are focused on the 10-year treasury and what is the yield of that. They're not focused on any other rates. They're not focused on the Fed funds rate, the 1 year, the 2 year. They're focused on the 10-year because that's what matters for the rest of the economy. And now we are at present day. President Trump has started his second term, and most importantly, he has Scott Bessent leading the treasury. They are both aware that what President Trump did last time in order to stimulate growth will not work this time. In other words, if they try to bully the Federal Reserve into lowering the federal funds rate like Trump did last term, the only thing that will happen is other interest rates for all other forms of debt will get much more expensive. But the problem is they both still believe that the key is low interest rates in order to drive growth. The goal is still wealth. The goal is still stock market go up. The goal is still real estate goes up. The goal is still unemployment goes down. The goal is still GDP goes up. And they both believe that interest rates going down are the key to that. They just can't get everybody's interest rates to go down by simply making the Fed lower their interest rates, which means they have to deal with the issues that are causing things like the 10-year yield to go up, which means they are focusing 100% of their efforts on things that will bring the 10-year yield down. Now, in case you don't understand why they're focused on the 10-year yield instead of the 20 or the 30 or the 2, it's primarily because this is the best benchmark for most forms of debt. When you look at corporate bonds, when you look at mortgages, when you look at auto loans, all of these are very closely correlated to the 10-year yield. If I can loan to the government for 10 years, that's essentially viewed as risk-free. And so any private loan that I make to a corporation or an individual is going to have a little bit of a higher interest rate on top of that because of the additional risk. That person can't use force of violence to collect taxes to pay back their loan. And so as the 10-year yield goes down, that makes other forms of debt more attractive from a lender's standpoint, increasing supply for the demand, driving all interest rates down. And because most mortgages are refinanced or paid off within a 10-year time frame, auto loans are nearing 10 years as well. Most forms of debt follow pretty closely along with that 10-year yield. It's a very good benchmark for all borrowing in the economy. And so when you look at the things that the Trump administration, Scott Bessent, Doge, have been focused on, these are all things that they believe will bring down the 10-year yield. The only problem with their approach is that they understand that it could cause quite a bit of economic pain in the short term before they get to their end goal. And just in case you doubt that the president and his administration don't care about the pain happening right now, but they do care about the long-term wealth, here's what President Trump said in a recent interview, that he is not looking at the market, that his decision about tariffs had nothing to do with the market. I'm not even looking at it because long-term, the United States will be very strong. In a recent interview, somebody asked him if he sees a recession this year, and he said he wouldn't want to predict something like that, but he says he knows there will be short-term pain, acknowledging that it's okay if bad things happen right now, economically speaking, because the things that they are trying to accomplish are going to mean it's better for the long term. Just in case it's not clear, they're not trying to crash the stock market because that will bring rates down. Crashing the stock market will not bring rates down. They're trying to remove the barrier keeping rates high, which is essentially inflation. In a recent interview, Treasury Secretary Scott Bessent talked about one of his first meetings with President Trump. And Trump asked him, how are we going to get the debt and the deficit down without killing the economy? And he said, I've been thinking nonstop about this for 18 months now, and it is a transition from public to private that will bring down or deleverage the government. In other words, what I showed you earlier, where the government's leverage is at basically an all-time high of 120%, they need to bring this down, which is both reduce reducing the deficit and the debt and making the economy itself grow, because it's simply the ratio of the government's debt versus GDP. He also went on to say that we will re-lever the private sector. In other words, he's trying to deleverage the government and make the private sector borrow more. The only way to do that is to bring down interest rates so that individuals and corporations will borrow and spend more. So the way that they are attacking this is through tariffs, spending cuts through Doge, and tax cuts. Now, with spending cuts and Doge, we've already seen tons of money faucets just shut off from the government that were just spitting money out to all sorts of non-governmental organizations and departments and agencies, government software contracts in excess of the number of people in the department, all sorts of money just flooding out. These were misallocations of resources, malinvestments, and unproductive private sector recipients of taxpayer money. Shutting this off will be painful for the recipients who were net destructive of wealth. That means that all of those private sector companies and non-governmental organizations that get the money faucet shut off are going to have short-term pain. This will contribute to unemployment for everybody who is on the receiving end of free government money. That is a bad thing for those individuals, but it is a good thing for everybody else because they were not net producers of wealth. They were simply taking yours. This is also the case with every federal employee who is getting fired. It is bad for that person individually, but assuming they are competent and assuming they are hard workers, they will be able to find a replacement job in the private sector where they're actually producing wealth for the economy. Again, short-term spike in unemployment and temporary pain for the people who were the recipients of those wealth transfers. For everybody else, it's going to get a lot better. We are also seeing tariffs cause uncertainty and interruptions in global trade. This is one of the key reasons why the overall stock market has fared so poorly recently. And it's also possible that all these things put together could even show a contraction in GDP. In other words, a recession. You get a spike in unemployment, corporate spending and investment slows down, goes on hold as the uncertainty about how the global layout is going to look over the next couple of years plays out. It's absolutely plausible that we are in the beginning of a short-term painful recession as a result of all these changes. But again, it's not the pain itself that is the goal. Every action by the current administration has the end goal of increasing wealth. And I'm not saying or making the case that it's going to work. I'm not making the case that tariffs are a good way to do this. I'm not making the case that the logic and the reasoning is sound. I'm saying this is the intention. Now, my personal opinion is that if you look at fiscal policy, meaning where they spend the money and where they tax the money, if they are able to cut spending enough that the deficit gets reduced to near zero, and they are able to do that while cutting taxes, the resulting economic explosion will be unlike anything anybody alive today has ever seen. I don't know if they will be successful with this, but it certainly does seem like fiscal policy, spending and tax cuts are one of the main goals. If there's any chance that that happens, then any pain in markets today looks like a generational buying opportunity, because undervaluation can happen from two things. Either the price itself adjusts downward or those future profits adjust way higher. At the end of the day, we will always have to just wait and see how this plays out. But every day that passes, it looks more and more clear to me that what we are seeing here is markets on sale, discount, great value, and that buying now is probably going to make your future self very, very, very happy that you did. As always, thank you so much for watching. Have a great day.